which is the underlying security. So when you exercise call option contracts, you end up owning IBM common. Even if you didn't know that, and even if you forgot that, and even if you weren't sure what warrants are about, there's no excuse for that one, because preferred has got nothing to do with common. Preferred is preferred all the way. It's not exercisable, convertible, or exchangeable into common. Are you with me so far? Yes. That would be considered not substantially IBM common. And so therefore, 7 goes to the higher level, and that is, and the final point, Mr. Johnson contacted the account executive for the purchase of IBM Common. IBM Common is on the wash sale list. The wash sale rules in effect. He waited 30 days prior to its sale, trade date of when he sold the stock for the loss, generating a loss, and waited another 30 days after the loss was generated, and bought back IBM Preferred. The loss is disallowed. He waited the right number of days, but he didn't buy back the same or substantially the original security. It is only when after the 61st day he buys either IBM Common or IBM convertible bonds or IBM warrants or IBM call option contracts will the loss be allowed because he waited the right period of time to buy back the original, substantially the original security, and therefore the wash sale rule has been overridden and the loss is allowed to be taken as a deduction against earned income of no more than 3,001 tax year. It's the end of today. Now, I need you to listen to me. We can't come in here on Monday and not know the difference between common and preferred. You know that can't happen, am I right? Well, are you with me? Yes. We're going to another level. Monday is 1/5 the NASDAQ. 1/5. 3 hours of tax shelters and 2 hours of margin trading, and I'm going to light it up into a level you're not going to believe. And it's not going backwards after Monday. We're going forward and blasting right into Friday on the end of week 2 to options. And then we're going to go into the annuities, retirement plans, and the bonds. These days are now going to become pretty involved. Are you with me? Very exciting. But we have to come with a little bit more of a basis infrastructure regarding our education. And that is that we've got to know pretty much most of the language that we've covered this week. And so let's talk about language. I'm handing out a pamphlet and a publication and a document to you that I want everybody to take right now. And this document is important to be able to stay in my program as opposed to anybody else's because of the language of next week and the way I trade with you. This document is called Understanding Market Risks. And I want you to listen to me for a moment. I'm going to walk you through it. Don't worry. You know, many years ago, I was honored to be asked to speak at a Securities and Investor Association convention in Miami, Florida. And there were a lot of guest speakers there. I was talking a little bit about what happens to the financial advisor after I train them and some of the trials and the tribulations that they went through. We all had different components and counterparts to that convention. It was pretty exciting. We're talking about new legislation. This is a byproduct of the publication of that convention. Are you with me so far? And this language here I think is very important to you because it's going to help you in week 2 to trade with me. I want to walk you through this publication because there's language here that you need to be aware of. If you crack open the first page, it starts talking about certain market cycles. And if you go to page 2, those are some of the cycles that I want you to be aware of in language about what the definition of a routine decline is, a correction, a severe correction, a bear market, and a crash. You'll find that any bear market territory is any index that declines more than 19.5%, establishes and defines the definition of bear market. Why? Coming from 87. When the market crashed on Black Monday of October 19th that we talked a little bit about on Wednesday, 508 points. It went down 22.3% for the index, which establishes almost 20% now, 19.5% from that era and that time and that date and that crash, the definition of what is defined as a bear market as opposed to a routine decline or a severe correction. Are you with me so far? Yes. Or a crash, if you will. They're calling that a crash now. Are you with me so far? Yes. Versus a bear market. Next page talks about some reasons why markets fall. I think we take a look at this publication, take a look at the real world, you'll see there's a relationship to actually these components. Are you with me so far? Yeah. It's kind of nice because I want to keep concluding us to the real world. The next page talks about how you ought to stay informed. And there, that point right under that, stay informed. You see that? Yes. Yes? Priscilla, see that? Stay informed. She's going to get it. There you go. See that? I waited for you. Nothing but the best service at this 4-star restaurant for you. What does it say under stay informed? Next paragraph. Invest for the long term. You know, that seemed to be a common theme today, didn't it? Yeah. Jesus, let's talk about investing for the long term. Go 2 pages after that and you'll see a graph that says, I'm just walking you through it, how risk falls over time. You see, the longer the holding period on the position, the greater the diversification of the portfolio, the greater the reduction of risk, the higher the net returns, and the lower the trading tax liabilities on those trading profits. Are you with me so far? Yes. You see? And so we get into diversifying the portfolio. And then the next page talks about the greater returns from a 1-year to a 5-year to a 20-year holding period on a position. Again, solidifying the argument that the longer the holding period, the greater diversification of risk and the higher the net return. Next page is another graph and another significant philosophy on how to invest on a regular basis and therefore how to diversify that risk with balanced growth over time. And on the diversification of investing regularly, you can turn the page now. We start talking about 2 more pages. Dollar cost averaging, keep turning, versus dollar averaging. And those are methods of accumulation of a position on how we can buy any security that will be introduced and were created when we established the regulations associated with mutual funds next week. Are you with me so far? Yes. But I want you to go all the way through to the next page, which starts talking about how you buy quality, and you should only buy exclusive quality for your clients. And then, of course, how you give the proper and professional advice. And then, of course, how you can diversify the risk versus return. Keep turning. You'll get it. And you'll go to the next page finally. You'll have plenty of time to look at this. I just wanted to walk you through it, kind of peruse through. But the final page, which is the second to the last, where it says tax considerations and conclusions, and I just want to know if you're there. Yes. Thank you. And I would like to read the conclusion to this document to you now, because I think it serves its purpose. Markups and downs are simple for investors, but go back to the paragraph above, tax considerations. When selling an investment and making a profit, you pay capital gains tax, and assets that are held for 12 months or less are taxed at the 35%. Short-term gains are taxed there, and long-term at the 15% tax rate. I think it's significant for you. This document, the language in this document is very powerful. Now, before we prepare ourselves, no chapter exams today. You'll have plenty of that next week. With NASDAQ, I have something I want to share with you that's a little bit over the top associated with the language of fundamental analysis that I promise you I will discuss with you today. We're going to take a 5-minute break because I really want to give this to you on the area on analysis fundamentally. It's going to help you next week. Are you with me so far? Yes. 5 minutes, a brief interlude for fundamental analysis. I'll see you in 5 minutes. That's the end of taxation. Thank you very much. How we doing?